Hey dude, so something popped into my mind after I finished recording, and we're talking about, okay, we're using data. We have to be tracking data. One step further from that then is the data has to be accurate. We have to actually allow the data to play out. Last month I posted a Instagram story about a trade I took. I took the trade and it was a roundabout or a round trip. Took the trade here, entered, take profit was here, went the whole way up, a couple of points, literally just away from my take profit, right back down, and actually stopped me out. Multiple people responded to that story saying that I should have taken something off. How can I let a trade go the whole way up there and it end up in a loss? And that seems like the logical thing, but in reality that's broken. It's a faulty thinking, because my system is mechanical. The only reason that I'm profitable is because I track everything. I take a trade, I see, did it work? And the stuff we have to track in terms of like our targets. We have to see, is our target, are we aiming for too little, let's say? So you don't have to, but I have a metric where I will track and see how much did price run on after my target was hit. If it ran on 1 or 2 or 3 or 5 or plus. Those 5 or plus trades, I have to study those and think, okay, what's happening here? This trade ran on 5 or, and I came out here. It's data, it's something I can work with. Whereas if I just close here because I'm close to take profit, I don't have that number, and the data isn't accurate. Same with stop loss. Stop loss, we should be tracking, was this a valid stop loss? Is in valid stop loss being price hit my stop loss, then proceeded to continue down. Valid stop loss. An invalid stop loss would be if price came down to here, wicked us out, and then went to target. That would be a stop loss, excuse me, an invalid stop loss, or a badly placed stop loss, let's say. And again, of course, it's going to happen in times where the market's just going to wick us out. But if this is repeatedly happening, we're getting wicked out and then price goes in our direction, that is an issue with our stop loss placement. We want to be, when we're wrong, to be wrong. We want price to actually keep going down this way as much as possible. So, tracking targets, tracking stop levels, tracking confluences. What is my most profitable variation of this trade, let's say? And then from this, we should be doing a review process where at least minimum once a month, we go into the data, look at it and see, okay, is there anything here we want to change? A weekly review, super necessary. The weekly review doesn't have to be quantitative. The weekly review can be qualitative, and for me, most of the time it is. I'm taking a fucking 1 to 3, 4 trades a week, tops. I don't have quantitative data that I can study every week, but I do every week need to study myself, qualitatively. I have to write words, I have to talk about, okay, what went well this week, what didn't go well, what market conditions was my edge strongest this week, where was my edge weakest this week. And also then, from that, getting used to tracking something else, a different confluence. Which type of market conditions was this trade taken in? Was it in a choppy market? Was it in a trending market? Was it in a trending range? Was there high volume, low volume? Then again, after 50 trades, we'll then see what is our best market conditions. We have our rules, the rules have to be there, but is our rules actually better when the market's going sideways, when we're actually getting a range-bound market? Because maybe we're a reversal trader and we take trades off the highs and the lows. Or if you're a trend-following trader, this is going to be where your edge is weaker. But we have to know, and we think that we know from just taking trades and just taking trades and fucking remembering. We don't. I promise you that I know that you think that you do. I thought that I did. And the data always surprises me, always surprises me. Like, one thing that really fucking shocked me recently was that I track whether the previous day was up or down, whether I was buying or selling. So in logic mind, we would think if the previous day was up and I'm buying, that would be higher probability than if the previous day was up and I was actually shorting. Because I'm going against the previous daily candle. I actually found out I had a higher win rate counter trending that, but the win rate was different if I take that in the first half of the day or the second half of the day. So again, all of these slight variations, you just add 1%, 1%, 1%, and inform the trader when we can actually push the boat a little bit. Because for me, that is everything. All I want to do is be able to know when can I actually fucking bet the house on this one. Like when can I slap 3% on this trade? I don't go over 3% because trading prop firms can be fucking slippage and shit, and you don't want to go over the 4 or 5% mark because you can lose the account. But when the setup is there, when my strongest confluences are there, when it's my A-star setup, I'll risk 3% all day, every day. So, but again, the data is what tells me when that 3% is. So yeah, again, use the toolkit, record the rules, and use the journal part for the confluences. Actually, I'll put a trading plan down below as well. The trading plan actually lets you outline your confluences, so you can make your list and then eventually wheedle it down and start tracking the data. It'll really help. Boom. That is all now. Have an amazing week.